Thank you for joining us for part 2 of our quarterly investment current series as we begin the back half of the year. I'm Tim Chubb, Chief Investment Officer here at Girard. I'll be sharing a bit about our market outlook, but if you'd like to hear more, please reach out to us by visiting meetgirard.com. There you'll learn more about how we can work together to achieve your financial goals. As Mark Bolster described in an earlier market update, the quarter really boiled down to 3 key drivers: inflation, rates, and growth. We'll review these further in upcoming videos, but for context, we saw a step up in inflation during the quarter, though the key drivers from earlier in the pandemic era are changing. Goods inflation has clearly rolled over when it comes to items like furniture and appliances, but we remain concerned that services inflation, highlighted by rising home rental prices, will continue to be sticky or move higher. As of mid-July, we've seen double-digit declines in energy and other commodities that should help moderate the July headline inflation reading. Inflation data has finally grabbed the attention of the Fed with a somewhat surprising 75 basis point rate increase in June. We'll likely see another 75 basis points later this month as we move closer to the target of a mid-3% range by the end of the year. Federal Reserve Chairman Jerome Powell stated willingness to inflict economic pain to get prices under control, and that has created a frightening of tightening environment that has spooked markets. The Fed has stayed on the sidelines longer than they should have because they viewed inflation as a supply chain problem. The Fed has few tools to impact supply, so they primarily target the demand side. Their efforts to tighten policy have slowed growth, as evidenced by recent ISM and other leading economic indicators, as evidenced by the gray line. You can see these indicators are beginning to fall, while coincident indicators in orange will move lower soon. Fortunately, employment remains strong, and consumer and corporate balance sheets are in great shape, suggesting a downturn should not be too deep. With that as a backdrop, let's look at some key themes as we begin the second half of the year. From a global growth perspective, Europe will remain challenged by the war in Ukraine and energy prices. On the flip side, China's emergence from the COVID lockdowns and the twin pillars of consumerization and industrialization that categorize emerging market economies make it a potential bright spot. Domestically, the economy is no longer benefiting from the tailwinds of government stimulus or easy monetary policy from central banks. Although we expect political uncertainty through midterm elections, they typically serve as a catalyst for risk assets to wrap up the year. Inflation, war, and the pandemic should come as no surprise as key risks to the economy and the financial markets for the remainder of this year. The last two are very difficult to predict, but are likely to drive long-term structural changes, including an unwinding of the hyper-globalized supply chains, just-in-time delivery, and a shifting of global political alliances. One key risk factor to keep an eye on is corporate profits. Excluding the energy sector, with an astonishing 240% earnings growth expected in the second quarter, the S&P 500 will likely see profits decline outside of this. Still, analysts that cover individual companies haven't meaningfully cut their expectations as rate increases have stunted growth. We look to 2015 as a comparable period and suspect earnings could drop as much as 8 to 10% in a recessionary environment. Of course, this doesn't mean investors should run for the exits. As Warren Buffett has said, the stock market is a device to transfer money from the inpatient to the patient. A 25-year average of the price-to-earnings multiple on revised S&P earnings gets you in the range of 3,350 to 3,500 for the index, down about 5 to 10% from where we currently stand in mid-July. We can look at history and see that equities, and to a lesser extent fixed income investments, tend to perform well after initial rate hikes. Mid-caps, international, and especially growth-style companies tend to do the best in this environment. It may seem counterintuitive, but the stock market is a discounting mechanism. If everyone has expectations or estimate cuts or slowing growth, this bad news can be viewed as good by the market if it isn't any worse than consensus has feared. We've referenced the concept of TINA for several years now, in that there is no alternative to stocks. When interest rates were near zero, money was plowing into equities, commodities, and even cryptocurrency to seek return. With the historic downturn in bonds in the first half of the year, yields have moved much higher and made fixed income much more attractive yet again. Yields move inversely to prices. High yield and emerging market debt offer the potential for equity-like returns with less risk and better principal protection than equities, but high yield debt still poses more default risk than investment-grade bonds, and emerging market debt still poses more currency risk and may be subject to more political instability than domestic debt. Following the sell-off in risk assets to start this year, the mentality of our investment committee has recently transitioned into believing it is now time to start swing yet pitches to get on base. This might mean dipping one's toes into high-quality companies with defendable market positions that have seen meaningful corrections. While we're certain to see continued volatility, our sense is that market leaders will move higher before economic fundamentals bottom and improve. There is opportunity in energy and materials not because commodity prices are high, but because the capacity to drill and mine has not received the investment to keep up with demand.
When it comes to U.S. stocks, many companies and executives are speaking with their balance sheets, as evidenced by insider buying and corporate buyback levels not seen since the first quarter of 2020. We also see value in small cap companies, particularly growth, given their lower foreign currency exposure and historic valuation discount. We're also concerned that the strength of the U.S. dollar will challenge large cap U.S. companies, but that is an opportunity for foreign businesses based in Europe or Asia. After 14 years of U.S. stock outperformance, relative valuations of non-U.S. companies appear attractive. These markets are seeing slower growth in general, but emerging markets are one area where investors may find growth, albeit with increased risk. Finally, the move up in bond yields has investment-grade bonds with yields around 3% and below investment-grade bonds with yields around 6%. Most bonds are trading at discounts to redemption value that one can add 1% or more annualized return through maturity. Through high yield spreads have significantly widened, the risk of serious default cycle appears to be low given high cash positions, limited upcoming maturities, and a higher risk of bonds that is just one notch below investment grade, reflecting better quality.
Despite the rocky path ahead, there are reasons for optimism as we look into the second half of the year. This is a great time to evaluate your tolerance for risk, especially when markets are bouncing around as much as they have been. And our team at Girard would love to help. We'll be back soon with more content, but in the meantime, feel free to contact one of our advisors by visiting meetgirard.com. Thank you for watching.